I just sold 2 stocks just the other day. In this video, we're going to be talking about the 2 stocks that I sold. I think it's going to surprise a lot of people. We're also going to be talking about OSCR today, OSCR Health. We're going to be going over that to see if they're an opportunity still or not, or did I possibly sell them? We're also going to be talking about Zeta. Zeta has been getting beaten down a lot as well. The entire market is getting beaten down. High beta, anything that Wall Street doesn't deem as safety right now is getting absolutely torched to the downtrend. So welcome in, friends. This is going to be a jam-packed episode. All I ask of you is to smash that like button and subscribe if you want to see more content like this. You could decide that throughout the video, whether or not this is the channel for you or not. But let's just get right into it. We're going to be talking about the markets. The markets have been absolutely brutal. We are talking about a 1 month or 5 days of straight down 4%. So we're in pullback territory on the NASDAQ. We're in pullback territory on the SPY. Let's pull up the SPY. Well, no, we're not in pullback territory yet. We're barely down 2%. The reason the SPY is getting held up so much right now, though, honestly, is because of safety stocks within the SP 500 that have gotten absolutely beaten down already. It's hard to get those lower from right now. IWM is actually holding up fairly decent, 1.44% down over the last 5 days. So really, it's the NASDAQ. It's big tech, and it's these SaaS companies, these subscription as a service companies. They're getting absolutely decimated. Shopify, Intuit, Netflix, financial companies too, Robinhood, SoFi, right? So many of these companies are absolutely getting devastated. But that's not what this video is about today. I did want to touch on that. The markets are absolutely red. Let's get into OSCR and Zeta, and then we'll get into the 2 stocks that I sold at the end of this and what I'm doing with that cash. So if you don't follow me yet on X, it's at the RonnieV Show. You can come on over here and follow me at the RonnieV Show with 47.5 thousand other people. We can scroll down here to a post that I made just yesterday. And this is me just being super transparent because I like to be transparent. I have private portfolios. I don't disclose everything I do in them. I have a public portfolio where I disclose everything I do, every single trade, every single investment that I do. That's all on Blossom. I'll link that below. It's an absolutely free app you can go download. And then in the investing collective, I just posted a ton of levels for companies like Zeta, Mobileye, Iren, OSCR, Nebius, Ondos, so many different stocks. I posted levels in there. I'm posting moves because I have portfolios in there specifically exclusively for the investing collective. So if you want to join the investing collective, that's also going to be in the link below. If you want to know what to do in times like these, know how to not just go out and buy everything, right? Use your cash properly and buy high conviction names for yourself at the right levels. So funny I say all that, right? And then I'm showing you this decimation that I have right now. These are my Zeta leaps. Now, if you don't know what a leap is essentially a 1 to 2 year bet on the stock going in a certain direction. So you can either buy shares and you just buy shares, you buy and hold them, and then you sell them when you want to sell them. Leaps are essentially giving you access to buy those shares later on, but only if you're over the break-even price by expiration. So to simplify it, one contract is 100 shares. If I buy one leap, I can exercise and claim 100 shares, let's say at $15. Let's say I have a $5 premium. As long as we're above $20 by January 15, 2027, I can go ahead and buy 100 shares of Zeta at $20. Well, let's say it's at $30. Then I'm up $10 on the shares that I just bought. It's like reaching into the past and buying a great company at a cheaper price. That's exactly what the leaps are for. And the leaps, the reason why they're so good without going super in depth, maybe I'll make a video. If you guys want me to make a video on leaps and how I use them and my strategy behind them, drop in the comments below, just say leaps. If I get a ton of people commenting leaps, then I'll go ahead and I will go ahead and make a leap specific video, how I do them. I'll teach you about them, so on and so forth. But We'll save that for another video. If you guys want it, again, comment below while you're down there. Smash that button. Appreciate you guys. So what we're seeing here and why leaps are so lucrative is because right now, I believe that Zeta should be a $37 fair value, should be a $37 stock. Today, it's sitting right around $16, $17. $16, $17. I believe it should be a $37 stock. We'll go over that a little bit today with our valuation and our projections and where they're going and about the flip to profitability. I believe they should be a $16 or $37 stock, and they're currently 16 or 17. So if I believe that, and I buy these leaps for 1 year, more so 2 years out for 2028, January 2028 expiration, I'm going and getting a 2 to 3 times leverage on those shares. So essentially, I could either buy shares or I could buy leaps and get 2 to 3 times leverage on if I were to just buy shares. Meaning I can go ahead and get more access to more shares. I can get access to more shares by buying leaps, more risky because if the price ends below this on or before expiration, right? Because you can exercise this whenever it gets above there, on or before expiration, then you lose all your money. But my thing about this is, well, if I invested $100,000 and Zeta at $20 and Zeta went down to $10 and I'm down to 50K anyways, and I'm unrealized 50K, where this right here gets me that same, right? But 2 to 3 times, I'm paying 2 to 3 times less and my upside is 2 to 3 times more, vice versa, whichever way you want to lean. So right now we're down heavy on these. This is all unrealized losses, about $10,000 to $15,000 in losses right here. Again, this is all unrealized. So as long as we get above basically 15 to, I would say the premium here is 20. This is 30. This is 20. This is 25. This is 25. This is about 30. And this is about 33. As long as we get above those prices I just rang off before 2027 or before 2028, these are going to be in the money. In the money, meaning all these losses will be gains, not losses. And I can go ahead and buy those shares. Either the stock's only a little bit above there and I could buy those shares for a little bit cheaper, or we're a lot above there, 50, 60, 70, $100 per share by 2028 on Zeta, and I'm buying it for 20, 25, $30 per share. You see what I mean? That's how lucrative it can be. So I fully plan to exercise all of these. I fully plan to buy those shares. I'm just doing this so I can get more access to more Zeta shares up front before we start really running. This pullback in Zeta is silly. The company, again, I think it's a $37 fair value and it's sitting at 16, 17. It's just getting beaten down with the rest of SaaS. Their margins continue to expand and go up. So let's talk about that, right? We're going over to valuesnapshot.io. Let's pull up the financials of Zeta. You see, we've been looking at Zeta. Let's look at a quarterly. We can clearly see, guys, clearly see the stock price is going down. Let's look at the stock price real quick. Zeta. We are down 29% over the last 1 month, currently sitting at $16.37, down almost 6% today, down almost 15% in the last 5 days. Year to date, down 20%, all time up 81%. And we started calling this out. We started calling this stock out around the $13, $14 range. So from where we started calling this out, we're still up. I get I've been bullish on this all the way up to $24, but that's because I believe it's a $37 fair value stock. I can't help that I believe it's a $37 fair value stock with the projections that I believe. While the stock price is going down, what are we seeing? We're seeing on a quarterly basis, free cash flow margins going from 7.5% to 15.6%. Operating and net margins going from negative 25, negative 30 to 5 and negative 1. They're about to flip the profitability. Here's their revenues up and to the right on a quarterly basis, about to flip the profitability. They only were not profitable by negative $3.63 million. And basically the story behind Zeta is they are a free cash flow machine right now. Look at this. Look at this. Free cash flow is exploding. Net income and EPS isn't there yet, but free cash flow is exploding. Free cash flow is the lifeblood of any company. When you have free cash flow as a company, you can go make acquisitions like they did with the Marigold deal, getting them more exposure to the Europe markets. You can buy back shares like they are doing. You can pay out a dividend, which they shouldn't do because they're going to grow 35% this year. They got it for 35% revenue growth this year. And then you can also pay down debt, which they don't even have a lot of debt. Look at this. Look at this. This is 1.15 assets versus 461 million liability. And then this is 385 million in cash and cash equivalents versus 196.88 million in debt. So they have almost double cash to debt, right? They're making a ton of free cash flow and they're about to flip net income positive. Look at this, earnings per share. It's been going up and up and up and up, and they're about to flip the net income positive. I believe 2026, especially with midterms is going to be a big, big year, which is why they're guiding for 35% revenue growth. It's going to be a big, big year for them to make a ton of revenue year over year. Because with midterms, this is a marketing company. Zeta is a marketing company. With midterms, they're going to be spending more and more and more money on marketing and targeting the right people for their ads so the Democrats or the Republicans or the third party can win their seats of the House, the Senate, their elections, blah, blah, blah. So this, you have what? We have margins climbing higher every single quarter. You have revenues growing over 20% plus for the past 3+ years. Now this year growing 35%, accelerating. We saw with Palantir. And you have, what else do we got? They're about to flip the net income positive and they're printing free cash flow like crazy. And they just made a Marigold acquisition, which gets them access to the EU markets. Huge, guys. It's so big. So you need to separate your mindset from, oh, Zeta's going down. The stock price is going down. Zeta bad. That's not what that means. Stock price going down can be a ton of different things. We just talked about the markets in the front of this video. And what did we say? We said all SaaS companies are getting absolutely destroyed. We talked about all SaaS companies getting wrecked, getting destroyed, right? And Zeta is a SaaS company. But the big difference is, and I don't even believe the whole narrative that SaaS is going to die and all these companies, these software as a service companies are just going to go away. I don't believe that. But anyways, for just Zeta, they are accelerating and doing better with AI. They have their own AI. They are disrupting companies like Adobe and Salesforce and Oracle, not being disrupted. It's a big, big difference there, guys. Big, big difference. Another thing I'll guide your attention to is going to be, look at this. Let's talk about valuation. Let's talk about valuation of Zeta, right? So not just me, but analysts, again, currently sitting at $16.30. The lowest analyst assumption. These are Wall Street analysts. These are analysts at the biggest firms out there. Wall Street analysts have a low price target. Their lowest price target is $25 per share. Again, sitting at $16.30. That is a 53% upside. And analyst price targets are 12 months out. So analysts are telling you buying today at $16.30, you will get a 53% return within 12 months. That's what analysts are telling you. That's their job, right? I'm not an analyst. I'm a retail analyst, which is a made up thing that I made up, where I talk about price targets and everything based on my valuations. And it's all my opinion, not financial advice, but it's what I believe, right? For a $4 billion market cap company that's about to flip net income positive, that has margins expanding, that has customer growth expanding like crazy, that's returning $6 for every $1 spent, 53% upside to the lowest analyst target of 25. Retail analyst Ronnie's price target is $37 fair value. Consensus is 29, which is 77%. And their high, which is closer to where I'm at, is $36, 121% return from $16.30 today. So it's not just me thinking that this is a great opportunity and a huge moat and phenomenal opportunity in the marketing space and in the stock market, one of the most undervalued companies out there. Also, real analysts on Wall Street believe this as well with their lowest price target for 12 months is $25. Dan Ives is also an advisory to this company as well. We just found out last week, which that's massive as well, because Dan Ives is like the tech guy. He's the tech guy. He's the one that was early on Palantir and everything. So we talk about valuations. We talk about beat this thing up into oblivion. Let's see. Let's say for the next 5 years, right? For the next 5 years at these trailing 12-month revenues, let's say they only grow 20%. They've been growing 20% plus over the last 3+ years. And now they're guiding for 35% revenue growth for just this year. So let's take an average of 20% over the next 5 years. They're currently doing almost 16% free cash flow margins now on a quarterly basis, and their last reported trailing 12-month is 13%. So we'll just be conservative and say 13%. Then let's say they're trading at a current price to free cash flow terminal value of 26. Let's just say, let's be super conservative and say 20. Well, that gives us still a 55% return. $25. Now you see why the consensus is, or the lowest, because for them to grow less than 20% would be crazy. For them to not increase margins, which they're already doing on a quarterly basis, would be crazy. For them to trade at anything lower than a 20 free cash flow multiple would be crazy. That's why these are conservative assumptions. That's why you get a 54% upside. That's why you're 54% undervalued at $16.30. And that's why the intrinsic value is $25 based on very conservative assumptions. If we go with what I actually believe, which would be my bull case, 25% revenue growth, I believe they get up to 17% free cash flow margin rates on average over the next 5 years. And I believe they should be trading at a terminal value of 30, growing 20% plus. You get a 247% upside. It should be trading at $56 right now. Right now, currently it's $16.30. It should be trading almost 3 times higher, based on what? Based on, again, these assumptions. If you believe they grow 25%, 17% margins, and 30 terminal value over the next 5 years on average, this is what they should be sitting at. And the fact they're going to flip to net income positive and keep riding that wave, massive, massive. So these are my unrealized losses. I'm not selling out of these. I maneuvered some of these today to feed into $12.50 calls leaps and more $15 call leaps to get rid of the crazy out the money right now for like $30 calls and $25 calls. It's a bit of a reach as of right now. I still think they get there, but I rather be safer with my leaps because I rather make sure I'm able to exercise my options and buy those shares. So all I've been doing here is buying more Zeta leaps. I mainly have leaps in this name because even if 2026 is a rocky year and some of 2027 is a rocky year, which I don't believe so. I think this is all this is just a no more than a 10 to 15% correction. And then we rip into year end, rip into 2027. So I think Zeta will be fine. I don't think the AI story is dead yet. I don't think it's a bear market. I think we're still good. I think this is just a correction that's needed to reset everything. So I believe all this is good and where we'll go, even with this correction and everything, it's just short-term unrealized losses. Even if this goes until end of 2026 and then 2027 is a banger year and they rip past all these, I still win. I still get to claim all these shares. That's what really matters to me. But I'm taking a calculated bet and putting out more leverage to basically get access to more shares. So that's Zeta. Now let's talk about Oscar real quick. We can actually just zoom right up here and we'll talk about Oscar. And I posted this on X yesterday. Ronnie, you never talk about Oscar anymore. I'm still here and my conviction is two friends, short-term pain for long-term gain. So these are my options on Oscar. I did the same thing today. I took these $35 calls and $40 calls and I sold out of those at a loss and fed that money into $15 calls and $12.50 or $15 calls and $10 calls to be more in the money, That way I can execute these, exercise these to grab the shares. That's what I want to do. That's what I'm doing with these leaps. I want more access to more shares. That way, if we keep running, I can reach back in time and grab cheaper shares. That's the point of this. So again, we're down about between 15 and 20K here. Again, all unrealized. As I get more capital, as we keep falling, if we keep falling, guess what? I'm going to keep buying more. I'm going to keep averaging down on these leaps. I'll keep adding to lower calls, lower in the money calls like $12.50 or $10. I'll keep doing it. I'll keep doing it because again, Oscar is trading at ridiculous levels. It's trading at ridiculous levels, guys. Let me see. I wanted to point your attention to this other post that I made about Oscar. Where's it at? Where's it at? Where's it at? Should be right here. Look at this. They're doing 11.3 billion trailing 12 month, 11.3 billion in revenue. This is a $3 billion market cap. Where are you at? $2.9 billion market cap. Oscar's a $2.9 billion market cap. $2.9 billion market cap. So less than that. They're doing over 11 billion in revenue. They have 1.5 billion in cash. Think of that. They are a $2.9 billion revenue market cap. They have 1.5 billion in cash. They're doing $735 million in free cash flow. And last year, they flipped from, in 2024, they were profitable. Last year in 2025, due to higher medical loss ratios, they flipped back to not profitable, but still kept a trailing 12-month positive free cash flow. And this year, they're guiding to flip back to profitability. If they flip back to profitability, and then 2027 is a crazy good year, what are we even talking about here? Their free cash flow is going to go back to $1 billion plus. Their revenue is going to keep expanding. Their net margins will go back to being 2 to 4 to 5%, between 2 and 5%. Their net margins are between 2 and 5%. Their bottom dollar is going to be $1 billion in net income. Then their EPS is flying higher. For a $2.9 billion market cap company, guys, come on. Are you kidding me? This is dirt cheap. Someone posted about the Google trends on Oscar. The Google trends over the last 5 years or so are up. So more people are going to Oscar for their health insurance. ACA subsidies might not get extended at this point. That's a whole shit show. I won't lie. That's a whole shit show. Excuse my language. I don't even care about that anymore. They guided for this year and said we'll get back to profitability this year in 2026 without ACA subsidies. They plan on expanding in ICRA markets, and they plan on continuing to expand in ACA markets. ACA markets are not ACA subsidies markets. And my good friend AC Investing, which me and him will be going live for Oscar earnings on my birthday, February 10th, me and him have been talking about and he's been posting about, guess what? Oscar is actually having less people walking away from them as a health insurance company without ACA subsidies than expected. Way less. They're expanding in some states and they're losing in other states. And they're growing out into, they're moving into new territories. So overall, will they probably lose some memberships in 2026? Yes, that's to be expected when ACA subsidies have gone away. But are they expected to have this 20% cliff, 20% drop off on memberships? Somebody was thinking, no, it should only be between, I would say max 10%, but I believe less than 5%. I believe they'll have a less than 5% drop off on memberships. And they'll be able to grow that right back and more. Guess when? In 2027. Guess what? They're charging more for health insurance and they're not having this huge drop off, which means more money. If medical loss ratios come down, medical loss ratios are essentially, there's an average and it's been elevated in 2025. If it comes, they priced it for up here. If it comes back down here, that's all margins. That's all bottom dollar, which they can only keep so much of that per rules and regulations of the government. They can't go and make $10 million on 11 or $10 billion on $11 billion in revenue because they priced it up here and it only costs down here. No, they can only, they're capped out on how much net income and stuff they can actually make. But at the end of the day, guys, at the end of the day, Oscar's stupid cheap. Oscar's still growing. Oscar still is doing very, very well out there. And this valuation is ridiculous, Can I sit there and say, oh, margins are expanding like crazy and all this other stuff like I could say about Zeta? No, I can't. But I understand the business at a high level and I understand what they're doing and I understand where they're going. So even though I can't say that, I understand that 2025 was a very weird year for all health insurance companies because of medical loss ratios coming down, being an issue, but I believe going higher, way higher. Medical loss ratios went way higher, way above the mean. I believe they come back down after they priced it for where it was at right now. And this is going to be a huge beneficiary to them and their business. And again, on a trailing 12-month basis, look, the margins went from negative 5.1 to 6.5 on free cash flow. So they're still higher than where they were, even after 2025, right, was a beat up year. So once medical loss ratios come back to the mean and come back to normal, guess what? This 6.5 is going to go to 12 or 13% because they charge up here and now medical loss ratios down here. That's all margins in between. And then look at this. Guys, they were net margin positive, operating margin positive, and then medical loss ratios ruined it, negative 1.5, negative 2.2. But again, for 2026, I believe medical loss ratios come down. They charge higher. They lose some up to 10%, but I believe no more than 5% of their members. And guess what? They climb back to 1.5 to 2 to 3 to 4% net margins, operating margins, both of these. And that puts them back to net income positive, back to EPS positive, and then a whole re-rating cycle gets boom, 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 gets hit up. Analysts come out and they start jacking up the price targets. Again, we look at this one. Is this one as crazy as Zeta? No. But Oscar's everybody's scared about them losing all their clients and all their memberships and blah, 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 which again, we just went over. It's showing in the numbers. It ain't happening. So they're currently at $12.62. They might hit a low of $11. They could break out of this consolidation that we've been seeing them in, and they could break down. They've been in this consolidation for a year. This consolidation right here, the low has been 11 to 12 bucks consistently, and then the high has been $20 to $22, up and down and up and down and up and down and up and down. They're at very, very strong support right now, and it's for a very distinct reason. 1.5 billion in cash, 1.5 billion in cash, 735 million in free cash flow, and that literally gets them pretty much at their market cap. It's silly. It's silly. It's so silly. It's so silly. The lowest analyst target over the next 12 months is $13. That's the worst case scenario. Again, that's still higher than where we are right now. The consensus of analysts is $16, and the high of analysts is $18, presenting a +3, +25, or +43% return over the next 12 months, which these two beat the market. And then you go down here and you sit there and let's run some projections. They're expected to do 12 billion for this fiscal year. By the way, let's see, 12,000,000,000. Nope, I'm sorry. Math, 12,000,000,000,000. Boop. 12 billion they're expected to do for fiscal year 2025 in revenue. I believe that next year will be probably a little bit of a pullback year. Maybe, I don't even know. They might expand revenues to 14 billion next year, to be totally honest with how much they're charging. But let's just say over the next 5 years, let's do a conservative, they only grow 10%. You know what? Let's say 8%. Say the next 5 years, they only grow 8% revenue. Then let's say they hold out between 4.5 and 6.5%. Let's say they don't even get back. Let's say they don't even get back to 12% free cash flow margins over the next 5 years, which I told you I believe they do. Very, very quickly. Let's just take the median between the trailing 12-month and the last 3 years of 5. Then let's give them a dirty, disgusting 5 terminal fair value. Up, what's that? Whoa, how did that happen, Ronnie? It's dirt cheap. 8% revenue growth over the next 5 years? Easy peasy. 5% free cash flow margins? Easy peasy. 5 terminal value? Disrespected. The average is 15. But let's just go with a disrespected 5. 73% upside. $12.62 to $21.84. It should be that today if you believe these assumptions, which I believe more than these assumptions. Guys, my bull case, I believe I have to keep it still conservative, right? But I truly believe 15% plus revenue growth over the next 5 years. I believe they get back. Let's just say they get back to, like, this is probably base case. Let's say let's say base case here, 15, get back to that 12% free cash flow margin and get a respectable, at least respectable 10. It's not even real. It's not even real. It's not even real. Not even real. Guys, 102 intrinsic value, the 10x, the 10x, 713%. It's literally basically a 10x, guys. My goodness. My goodness. Be conservative here. 452% upside. Be moderate. Be aggressive. It's just stupid. It's just stupid when you type in these numbers, guys. So go off analysts, go off me, go off whatever. Like, you do you, right? You do you. I'm not worried about my losses, unrealized losses on my leaps. Not worried about it. I'm buying more. I've been buying more, and I just showed you why. It's severely undervalued, and the cash is basically, if they liquidated the whole company, you're barely going to lose money anyways at this point. Whatever. Everybody do what they're going to do. So that's Oscar. That's Zeta, guys. Everybody's been wanting me to talk about those two companies. Everybody's been wanting an update on Oscar and Zeta. There it is. There it is. There's my update. Nothing has changed. I'm buying more. I'm down heavy on my leaps, but I don't care because I understand that if I invest in an Oscar or a Zeta, 9 out of 10 times, 9 out of every 10 times, I'm going to win big on those stocks because the fundamentals are there. The leadership is there. I didn't even talk about Mark Bertolini during that whole time with Oscar. And that's like one of my biggest, sorry, I just squirreled to a moving van. It's one of my biggest bull cases about this company, that Mark Bertolini went from Athena, that's Zeta. Oh my gosh, that's Athena Zeta. Went from Aetna Group, which was a health insurance company, and basically 5 to 10x them over his tenure. Then he was also big boy on Wall Street next to Ray Dalio at Bridgewater. Guys, he knows his shit. He knows, excuse my language, he knows his stuff. He knows his stuff, man. So bet against them. Bet against them having literally as much cash and free cash flow as their market cap. And then the numbers showing on Google Trends that more people are talking about Oscar. More people want to be with Oscar on a health insurance. Less people are actually, there's less of a fall off. There's less of this drop off cliff without ACA subsidies. Geez, if they actually did come out and give ACA subsidies, they would be $20+ tomorrow. Who knows if that happens? I'm done caring about it, to be totally honest, because it's just a mind. It just hurts my brain because politics and politicians are annoying. And yeah. So there's Zeta, there's Oscar. Now, finally, let's get into the two stocks that I sold to actually put money into them, and then we'll wrap up the video. Do me a favor. If you're a Zeta investor, if you're an Oscar investor, if you appreciate my time talking about these stocks, if you appreciate these videos, all I ask of you, hit that button, subscribe if you want to see more, and hit the notifications bell so you never miss me going live or my next video, talking about my next big investment, talking or updating about my investment, talking about my public portfolio, so on and so forth. Appreciate you guys. So here it is, FLNC. So I did this in the GEMS portfolio, which is the private portfolio inside the investing collective. We were buying this at $16.69. It's funny because I first called out Fluence Energy, FLNC. I first called it out at $10 live on X. Called it live on X at $10. It ran to $32. And we bought in here at $16.69. I think I bought in at like 10 or 11, and then it ran up big, and I was like, I ran up way too fast, and I sold, and then I bought back in on a pullback because it ran 25, then back to 16 or so. I don't know. But we locked in $2,000, 82%, and we've been trimming this too. We've been trimming this up at $32 and $30. So we've been trimming this. So you can see right there, $8 to $30 price ranges for analysts. So we decided to go ahead and walk away from this. And the craziest thing happened, guys. We walked away from this. Let's see. FLNC and ONTO Innovations. This one we were up 48%, bought at 132. First called it out as a trade and a partial investment at 88, and it ran $205. So we also fully exited this one. We've been trimming this one up in the 200s as well. Basically, the reason I trimmed both of these is because they both hit their fair values. They both hit or were above their fair values. And I saw where the markets were going, and I decided 2 days ago, no, I need more cash. I need more cash. So let me sell out of these at or above fair value. And based on my charting skills as well, I saw that they were just topping out there. The funniest thing happened, guys. So we locked in total probably $3,000 here because we had 60 shares, maybe 4,000. But here we locked in $1,278 in this gems portfolio, right? You see it right there. We sold at 30.41 on FLNC, and we sold at 195.77 on Onto. 30.41 on FLNC. We sold 2 days ago, 150 shares for 82% at $2,000. And the funniest thing happened, guys. Remember, sold at $30.41. They had earnings coming up, FLNC. You're not gonna believe this. Again, guys, 30.41 is where I sold. Where's it at? Where's it at? FLNC. Here you go. Just posted levels too for all these stocks. FLNC, I said EPS fair value is $25. DCF fair value is $35. So they're overvalued on EPS and slightly below value on DCF intrinsic value, right at $32. So again, I decided based on the charts and based on how much they've ran, how fast, I said, and going into earnings, I said, they might disappoint and they might fall. My goodness, guys. Just today, they're down 33%. I sold at $30.24. It's now basically $11 lower. $11 lower. Now, guess what? Now I'm in there in the Discord and I'm telling everybody, let's go, guys. Let's go. This is where these are the levels. I want to be a buyer at 18.52 first, and then I want to be a buyer at 15. Then I want to be a buyer at 12. I want a little like pod shots, 18.52. Then we'll buy again at 15. Then we'll buy again at 12.37. We'll have our position built up again, and then we'll go back up to the upside because they're still undervalued. Nothing has really changed with their earnings. It's just people thought they were going to start spinning up S and revenue way faster, but they have so many big contracts for next year, guys. So many big contracts. And Fluence Energy is a big player in electronic grids and electronic equipment. And they're going to be a big player in the build out of data centers, AI movement, and guess what? The new electric grid, the new power grid for the United States that needs to get built because it's ancient. FLNC is going to be a huge player in this. So past 6 months, up 110%. We locked in our profits. We were calling this out at 10. Now we get to let it fall like a knife. It's down 37% in the last 2 days. 37% in the last 2 days. 33 down to 19. Crazy. But guess what? I'm going to start buying at 18.50 and then 15 and then 12 or 13. Build out my position again. Probably going to build out my position in 2028 leaps. And there we go. That's how we do it. It doesn't always work out like that. Time in the market beats timing the market, guys. But this was just one that I sat there and I said, my conviction's high on this one, but it's not as high as Zeta, Oscar, Mobileye, and even Path. So I just decided this ran a lot and it's okay to trim or to exit a position and just say, you know what, if it falls back to a lower price and if it keeps running, it is what it is. And for this situation, it's fallen like a rock right back into Papa's wheelhouse. Let's go. And then on to innovation, not so much. It's basically just chopping around. It's also down 10% over the last 10 days or over the last 5 days. So we're right about, we sold at 189. So basically right now it was just us selling today, essentially. So nothing much has happened there. For this one, for Onto Innovations, it was very easy for me. The fair value is between 189 and 193, and we ran up to 200 and some, right? We ran up to, we ran up to 225. So I've just been trimming up here. I've just been like, it's overvalued. It's at value. I'm just going to go ahead and trim. Semis look weak and they might pull back here. So those are the two stocks that I sold. Onto Innovation, Fluence Energy. I do still love these companies. I do want them at lower prices. I'm just okay not holding them right now at current prices. And then we talked about Oscar. Nothing has changed for me. Still bullish as ever. And it's even cheaper than my cost basis. Nothing has changed for Zeta. Still love it. Still think it's going to be a great company in 2027, 2028 and beyond. I want to get as much leaps as I can to get as much access to shares as I possibly can. And that's it. That's it, guys. That's the name of the game. When markets are red like they are today, in the past couple of days, and they might keep going. And I think max we have a 15% correction, 10 to 15%. Don't go out there and try to buy every great company. Go out there and buy the companies you have the most conviction in. That's it. Tune into the live streams with me. I'm going live multiple times a week, typically at 9:30 or at 11 a.m., 3 to 4 times a week. Make sure you hit that subscribe button. Make sure you hit that alert button. We're talking about charting. We're talking about levels. We're talking about investing. We're running through the next best stocks, stocks that are undervalued. I'll tell you what stocks are undervalued. I'll run through my projections for stocks that you want me to. If you comment them on the live stream, come learn. Come hang out with us. It's a great time. That's it. Hit that like button, guys. I love you all. Stay safe out there. It's going to be okay. I'll talk to you guys in the next one.